Welcome, everyone, to this week's Mortgage Minute. My name is Art Alvarez. I'm with Mortgage Works, where we have the answers and they're on the house. I am coming to you from beautiful, sunny Palm Springs area, the Coachella Valley. Have a nice, moderate spring day. We're only at about 95 degrees here, so hopefully it's a little cooler where you're at. Full disclosure, we're actually going to be moving our offices this week. The building we're in got sold, and where our moving day is actually Thursday. So I decided to do a special segment this week. And I want to talk specifically about closing costs. Closing costs are a hot button topic in the mortgage industry. It's something a lot of borrowers are very focused on. There's a lot of, I think, misinformation about closing costs, whether or not they're justified, what these charges are for when you're getting a mortgage, closing costs as it relates to getting a mortgage to buy a home versus paying cash for a home. So there's lots of detail and numbers to talk about that I want to go over so I can hopefully help you understand better the whole concept of closing costs. And maybe you'll realize is that in a lot of cases, in fact, in most cases, the closing costs you're going to encounter on a home purchase transaction are valid, they're justified, and there are reasons for them. So with that, I want to go ahead and just jump into first, give you a quick rate update. As you know, we always do every week. So I want to refer you again to our website where you can see our rate grid. It's right on the homepage. This is a rate grid that gives you what I call interest rate indications, because obviously the rates you see here are based on certain criteria that not everybody meets, but it gives you a general idea of where rates are at from week to week. And in particular, I want to direct you to that tab at the bottom of the rate grid where it says about mortgage rates. If you click that on, I go into pretty good detail about mortgage rates and most importantly, how they're determined. I oftentimes get a phone call where I'll be asked, what is the rate today? And in this tab, I explain why I'm not able to answer that question directly without asking a lot of questions to get a better idea of the borrower's scenario that they're trying to get an interest rate quote for. So again, I direct you to that tab when you have time, read through it. It gives you very good information about how mortgage rates are determined for a particular transaction. So with that, we're going to go right into our closing cost presentation today. And what drove me to put this together is I saw an article that was entitled, as you see on the screen here, What Exactly Goes into Closing Costs? It was published on May 4th. It's actually from CNN. And it was an interesting article. I think some of the parts of the article were on point, but some were a little bit off base, and I want to review that. In fact, here's a summary of what we're going to talk about today in this segment. First, I'm going to do a quick review of this article from CNN, what they got right and what they got wrong about closing costs. We'll talk about what are closing costs and when are they paid. We're going to talk about, does the amount of closing costs vary between a cash purchase and a financed purchase? We're going to get into some technical terms like non-recurring closing costs, which I'll go ahead and reveal to you now. Those are generally one-time fees. And then there's recurring closing costs, which I want you to think about as ongoing expenses. And then, of course, the hot button for everyone, junk fees. You hear that term constantly. And in fact, in the CNN article, junk fees are discussed briefly. And I'm going to touch on that and whether or not CNN got that subject right. And of course, in part of the article, it talks about, are junk fees inherently unjustified? I would argue it's kind of a mixed area, kind of a gray area. In a lot of cases now, most costs that are referred to are considered junk fees. That's not actually correct, and those fees are justified. And then finally, I'm going to finish up with what's going on with this NAR settlement, the National Association of Realtors settlement, that's had this big impact on real estate commissions and how they're going to be disclosed and paid, and whether or not those are going to have an impact on buyers' closing costs when they're purchasing a house. So with that, let's go ahead and jump into the details. On the next page, I'm going to go ahead and do my review of the CNN article, what they got right, and what they got wrong about closing costs. So first of all, the article does a pretty good job of answering the next bullet point. What are closing costs and when are they paid? Well, as the article explains, and again, I'll give them kudos for getting this part right, fees paid at the end of a real estate transaction covering various services and expenses necessary to finalize the sale. I think that's a good, accurate description of what closing costs are, just in a general way. Now, where I think the article misses the mark is it then discusses percentage average for closing costs on a transaction. I don't like talking about closing costs as a percentage. The reason is I think that's sort of a lazy way to kind of estimate or thumbnail estimate what closing costs are. And in this respect, I think the article really kind of provided some misinformation. Why? Because it mentions that closing costs typically range between 2 to 5% of the loan amount. Well, I call, you know what, on that, I put not, because I think that's an oversimplification and frankly, an overstatement of how much closing costs can be on any particular purchase transaction. And I'll get into more detail on that shortly. The other thing it does when they describe closing costs as a percentage of the transaction or of the loan amount, I think it oversimplifies what is really a pretty complex issue. You know, the actual percentage of your closing costs can vary based on location, lender practices, the specifics of your loan. For example, your loan size. Very small loan amounts, yes, the closing costs are going to be a higher percentage compared to higher loan amounts. And then, of course, the article doesn't even touch on another version of how you can pay closing costs, which is the quote unquote no closing cost loans. All those are loans where the closing costs don't just disappear. They still exist, but they simply get rolled into the interest rate offered to you by the mortgage originator, which of course that does overall affect the cost of the loan, just in a different way. You're essentially paying your closing costs through a higher rate and a higher monthly payment instead of paying them as a cash cost or expense. So I think now on the next slide, I'm going to go over one other area where I think this article got it wrong, is it describes how some fees, and the article actually presented a credit report fee, that it might be a junk fee because they can be unnecessarily high. Now, how they miss the mark on that is a credit report fee is absolutely positively not a junk fee. It is a fee for service, or in this case, product provided. That's not junk, folks. A credit report is a critical piece of your loan file. So to suggest that charging you for a credit report is somehow a junk fee, I think really misses the mark. And as I put there, labeling fees as junk can be misleading. Many so-called junk fees actually cover legitimate administrative costs or services provided. Dismissing these costs, these junk costs, overlooks the actual services provided, like credit reports. So in fact, on credit reports, I think where this article kind of got off base is it's true. Credit reports, the fees for credit reports went up dramatically last year. Credit reports now are basically about almost 3 times the cost that they used to be. That doesn't make them junk, though. It's still, again, a critical piece of your loan file. They cost a lot more now, but otherwise a credit report is needed, and paying for the credit report should not in any way, shape, or form be considered a junk fee that is unjustified. It is very much justified. So the overall point here is a buyer should focus on transparency and ensure they're not being overcharged, rather than assuming these fees are inherently unjustified. In fact, for a credit report fee, there is regulatory restrictions that are very specific. As a mortgage originator, when we order a credit report, we of course pay for it up front, and then we that is charged back to the buyer at closing, so we get reimbursed. And in that respect, we're not allowed as a mortgage originator to charge more than the actual cost of a credit report. That's essentially quote unquote illegal. So in that respect, yes, as a buyer, you want to focus on the closing costs, make sure you're not being overcharged, but also understand there's a lot of regulatory guardrails and requirements that help create or help avoid situations where you're being overcharged for any of the services or products that are provided for when you're getting your loan. The other thing I will point out is that cash purchases will have less closing costs because there are less administrative or third-party costs being charged to you for various fees and services. And of course, the other issue is you're going to have no advance funds provided to set up an impound account for taxes and insurance, because as a cash transaction, you're not going to have a loan where taxes and insurance can be impounded and paid monthly through your mortgage payment. So I would want you to understand that distinction. So with that, I want to go into the first part of the closing costs topic as it relates to non-recurring closing costs. Now, the way to think about non-recurring closing costs, look at the box at the upper left. Non-recurring closing costs are one-time fees associated with obtaining a mortgage and closing on a property. These fees are paid just once at the time of closing. Now, again, as I pointed out, cash purchases will have non-recurring costs too, but they'll be less. And again, we'll come back to that a little bit later. Now, what are mortgage-related non-recurring costs? Well, these are essentially going to be predominantly either loan origination fee or points charged from the lender or from the mortgage broker, the mortgage originator, essentially. Non-recurring mortgage-related costs are going to include a loan origination fee in some cases, as well as points, particularly if you're asking for a lower rate that's below market where points have to be charged. But most of the other mortgage-related non-recurring costs, again, one-time expenses, are coming from third parties providing specific service or product as part of the loan process. And here's a list of the most obvious ones. Appraisal. If you're getting a mortgage, you're going to have to get an appraisal on the house. There's a fee for that. Again, those fees are relatively regulated in the sense that they don't vary much from appraisal management company to appraisal management company. Credit report, we've already talked about. VOE fee. Well, that's a fee that's come up in recent years. What the heck is that? Well, a VOE fee is verification of employment fee. Does that mean that I'm going to charge as a mortgage originator a fee to verify your employment with your employer? Well, kind of yes and no. The reason is many employers, and certainly most of the major ones out there, when we encounter a borrower who's working for maybe a major corporation and where we have to send a form to that company to verify the borrower's employment, which is going to include their start date, their job title, how they're compensated. Are they paid a salary, an hourly rate? Do they get bonus, commission? That form historically would be sent to the employer, filled out by the employer's company, usually their HR or payroll department, and then sent back to us. Well, in this age of automation, many major corporations now have offloaded or basically deferred to a third-party vendor who provides the verification of mortgage verification of employment on behalf of that employer. And so it's more of an automated process. What's the downside to that? There's a fee involved. We didn't used to have to charge a fee or pay a fee to get your employment verified with your employer. But now, if you work for a major employer, they may have essentially offloaded the verification of employment process to a third-party vendor. The most common one in the U.S. is called the work number. So if we end up having to order a VOE through the work number system, the work number charges us a fee for that. And guess what? It's not cheap. Generally, it's going to be somewhere between $100 and $150, literally, to plug in your data. And in an automated fashion, we get back a form that's printed, that we print, and it gives us all your employment history. And again, it's not inexpensive. It's a big number, $100, $150. And if we have multiple borrowers, husband and wife, and they both work at major corporations, we could incur that fee a couple of times. And of course, that gets passed on to you. So before you shoot the messenger, if you will, the mortgage originator, if you're unhappy with that fee, you might go back and talk to your employer and say, gee whiz, it's a nice service to provide, but it's very expensive. Can't we do something about that? Of course, I don't think that's going to go anywhere, but at least understand why that fee is now a part of many more loan files than it used to be. Another one is very obviously to most people who have bought a home, your escrow fee. And I put settlement fee because, of course, in parts of the country, most of the rest of the country, the escrow fee is not referred to as an escrow fee, but a settlement fee, because a lot of places they use settlement attorneys. So escrow and settlement fees are going to be a non-recurring one-time cost associated with purchasing the home, both when you're getting a mortgage as well as cash, which I'll touch on in a minute. When you are getting a mortgage, you're going to have lender's title policy. This ensures the lender for clear title when you're buying the property and you're getting a loan to finance it. Because as you become the owner, you could bring something to the table in terms of your background that could create a cloud on title. So when you're getting a mortgage, the lender is going to require that you get a lender's title policy. There's a fee for that. It's usually several $100s. And again, that protects the lender in case your ownership of the property creates a cloud on title. If you're buying a home that's in an HOA, whether it's a condo or a single family residence, and particularly with a condo, we may have to order certain documents, in particular on a condo, what's called an HOA condo questionnaire. And with some HOAs, again, this could be several $100s. And again, we're the messenger. We have to get this document as part of your loan file. We don't determine the fee. That is coming from the property management company that is being used by the HOA in the association that you're buying your home from or buying your home in. So again, that's a justified fee for services, or in this case, a product provided, a homeowner's questionnaire for condos. There's other tax service. That's a third-party fee that lenders use to monitor your property taxes to make sure you're paying them on time. Flood cert, again, a third-party fee. A lender offloads that to a third party and orders a certification on whether or not your home is in a flood zone. If it is, you have to get flood insurance. And of course, recording fees. On a purchase, you're going to have a recording fee to record a grant deed, transferring the title from the seller to you, as well as a recording fee for the mortgage that's going to be recorded at the county recorder's office and establishes the secured lien against your property. Now, on a cash purchase, you'll have some of these non-recurring costs, but not as much. You'll still have an escrow and settlement fee. In a cash purchase, you're not going to have a lender's title policy. You're going to have an owner's title policy. That's where you, as the cash purchaser, may have to pay that, because in some cases the seller may require you to pay that. You may still have to incur some HOA doc fees, and then of course there are recording fees that you'll have to pay. You won't have to pay for a mortgage recording, but you would have to pay for a grant deed transferring the title from the seller to yourself. So a cash purchase will have some of these non-recurring costs, but not as many. So that pretty much, in sort of a summary fashion, is what non-recurring costs are. Again, think of them as one-time fees. If you're getting a mortgage, these one-time fees are going to be higher than if you're doing a cash purchase. Now, the other major segment of closing costs is what we call recurring closing costs. In the case of recurring costs, the way to think about recurring costs is ongoing expenses. As the upper left box indicates, recurring closing costs are ongoing expenses that the buyer will continue to pay as long as you own the property. And these are usually prepaid items at the time of closing to cover future expenses. Now, mortgage-related recurring closing costs are going to be a few things. Number one, prepaid property taxes. When you close a purchase, there's typically going to be a proration for the current period of property taxes between the buyer and the seller based on the day of the month that you close. As you may know, at least in our market area and most of California, property taxes are paid twice a year in 6-month installments. So for example, if you're closing now in May, the seller is going to have to pay the property taxes from January 1st to the day in May that you close, but then you as the buyer are responsible for the prorated property tax from the day in May you close through June 30. And so that's considered prepaid property taxes. Now, if you're getting a mortgage and you are required to, or you need, or you prefer to have a property tax impound account, then what happens is you have to provide what I call advance funds at closing to set up the account. Why? Because of the timing of when the next property tax installment is due. For example, if we're closing a loan at this time of year, May, June of the year, your next property tax installment is going to be November 1st. Now you have until December 10th before they're considered delinquent, but it's going to be November 1st. Well, guess what? If you close escrow in May or June and your first payment date isn't until 30 days after the first of the month, after the month you close, remember we covered that a couple of weeks ago, you will not have made enough mortgage payments to that lender for them to accumulate the 6 months of taxes that are going to be due by November 1st and delinquent after December 10th. Solution, you prepay. several months taxes now when you close. So the lender already has essentially a starting amount of money to add to as you make your mortgage payments, so that they have that 6-month installment available in November when they make that disbursement. And of course, they're allowed to have a cushion of usually 2 months of your monthly property tax amount. And so, for example, this time of year, you're getting a mortgage, you're having an impound account, you may have to cough up 4 to 5 months of taxes at closing just to set up the account. But again, this is not mortgage related per se, because even if you don't have a mortgage, you're going to have to pay property taxes. The difference is you won't have to set up advanced funds or provide advanced funds to set up an impound account, because you're not making a mortgage payment for the impound account to even have to exist. But again, it's not a loan related cost where you're being charged a fee by a third party. Now, mortgage related recurring closing costs, well, I've already actually gone over that. Well, actually, the last one I want to go over is, or the part of this box in the lower left, is first-year homeowners insurance. When you close escrow, you got to pay a 12-month premium to have the home insured on the day the loan funds. And now, again, you would want to do that if you're doing a cash purchase, right? But in addition to that, you would have to provide some advance funds for the insurance, just like the taxes. In this case, it would typically be 3 months of that annual premium. So when you're getting a mortgage, you've got your 12-month premium and then 3 months more to set up the impound account. But again, that's not a fee being charged to you by some, highway robber mortgage originator. That's something that is just required as part of your impound account, and it's an advance fee of what's going to be an ongoing expense. Same with HOA dues. When you close escrow on an HOA, on a property in an HOA, you typically have to pay 1 month of the HOA dues in advance. And in fact, you may also have to pay some transfer taxes, HOA transfer, not taxes, transfer fees, to transfer the ownership from the seller to you as it relates to the homeowners association. And then finally, when you're getting a mortgage, obviously, you're going to have prorated mortgage interest that you wouldn't have on a cash purchase. That's going to be prorated from the day of the month that you close to the end of that month. So, of course, as we talked about a few weeks ago, you could close at the end of the month. That prorated interest will be lower, but then, of course, your first mortgage payment is going to be sooner. At the upper right box, there I do cover cash purchase related closing costs, recurring basis, your prepaid property taxes, again, that proration just for the period when you're closing, that 6-month period when you're closing, where you're at, your first year homeowners insurance, and then, of course, paying 1 month in advance of HOA dues. What's interesting about recurring costs, and I'm going to demonstrate this in a minute, is recurring closing costs. Again, most of these have nothing to do with the mortgage you're getting itself, other than the prorated interest. Recurring closing costs can oftentimes be a larger share of your total closing costs than non-recurring closing costs. So I'm going to demonstrate that for you in just a minute. In fact, what we're going to do now is Jeff is going to pull up a copy of a closing cost worksheet, which, by the way, let me comment on this worksheet real quick. One of the benefits we provide to our borrowers, at least those who we hope will become our borrowers, when we first get an inquiry, is we will provide this kind of detailed information about a particular loan scenario even before you apply with us. Now, a lot of mortgage originators will not do that. They'll tell you, no, I can't give you any kind of estimate until you submit an application and I gather a certain list of information like your income, your assets, your social security number, and so forth and so on. That's not necessary to get detailed information like that. We can provide one of these worksheets with just some basic parameters: your purchase price, what loan amount you desire, what you think your credit score is. And with that information, we can provide this detailed worksheet because, again, it's based on assumptions you give us, what your purchase price is, how much down payment you're going to provide, what your loan amount is going to be, what you think your what you think your credit score is. With that, I can provide this kind of detail. Now, again, is this a document that can be relied upon once you apply? No. In fact, there's a big disclaimer at the top of the form. Your actual rate, payment, and cost could be higher. Get an official loan estimate before choosing a loan. So this gives you an initial indication, more or less an initial price of what it's going to take in terms of closing costs to get the loan based on the parameters you give us. So that's really why, and we do this up front, again, even before you apply. I'm a big believer is you have to have some idea what this loan is going to cost you before you even apply for the loan. So that's something that I think is unique to MortgageWorks and where we differentiate ourselves from our competition. So with that, let me point out to you a couple things. On this segment of the worksheet, and by the way, we split it up into 2 pages because we wanted to make it large enough that you could read the text. This upper left box in yellow, these are typical non-recurring, again, think one-time fees associated with getting a mortgage. And you can see some of the fees I talked about earlier on this list. VOE fee is at the top, appraisal, credit report, tax service, flood cert. I mentioned all of those on the previous slide. Now, and you can see near the bottom, this section, these non-recurring one-time costs in this particular scenario is about $6,043. Well, guess what's interesting? I will tell you, if you go back to the top in yellow, where you see that title, where it says title dash email docs loan tie-in fee, which by the way, that comes from the escrow office. From there down, all of these fees listed below that are all from escrow and title. They're not coming from the lender at all. They're not coming from the mortgage broker. They're not coming from the bank. These are from the escrow and title or title company that the parties to the transaction, typically the seller, choose when you open escrow. So I want you to understand that even with the non-recurring costs, in many cases, at least half or more aren't coming from the lender. So they're not really associated with the loan directly because they're fees that are coming from the escrow and title company involved in your transaction. Now, where everybody gets thrown off when I send one of these out is they'll oftentimes, when they're kind of perusing the form and looking at it, in line F there in blue, they'll look at that and they'll see that big number, over $11,000 for this loan. And it's like, oh my gosh, this loan's going to cost me $11,000? No, not quite right. That's kind of misleading in a way, and I recognize that. And that's why on the next page, I'm going to show you why that is. On the next page, this is the bottom portion of our worksheet. In the lower left, in green, these are your estimated prepaid items. Again, think ongoing expenses. What are ongoing expenses when you own a home? Well, primarily property taxes and homeowners insurance. Now, in this case, this scenario is based on getting a loan. So you do have prepaid interest or prorated interest. That's the very first line at the top, $316. This is based on closing at the end of June, in this case, June 28. But the rest of the items in this section, again, are ongoing expenses related to the property that you're going to pay whether you have a mortgage or not. Obviously, the next one, homeowners insurance. That's the $2,000. We're estimating $2,000 a year in this example. As you know, homeowners insurance premiums are way up. HOA dues in advance. You see $250 in this example. Again, even if you're paying cash, you're going to have HOA dues. If you're setting up an impound account on the mortgage, which in some cases you're forced to, in some cases, a lot of cases, you choose to even when you're not forced to, after you pay that first year premium at closing, you're also going to provide another 3 months of that premium at closing to set up the impound account for insurance. And then ditto with property taxes. As I just explained, if you're closing in May or June, you're most likely going to have to pony up 4 to 5 months taxes at closing to set up that impound account, because your first mortgage payment isn't going to start until probably July or August. And by the time the next 6-month installment of taxes are due in November, you haven't paid 6 months payments to the lender, so they can accumulate the 6 months that are needed to pay that next installment. So you pay 4 months in advance at closing. And then as you start making those payments in July or August, they add 1/12 of your taxes to that 4 months, so that by the time November rolls around, the lender will have not just 6 months accumulated, but probably 8. And they're allowed 2-month cushion. That way they can disperse that next installment of property taxes for you. Now, whenever you're setting up an impound account, there is what's called an aggregate account adjustment. That's that negative number of 781. I won't get into the technicality of that for now, but look at the bottom line of these recurring closing costs, $5,400. And of course, up at the top of this part of the page, you see $6,043 for non-recurring costs. That's how you arrive at that total in blue of $11,483. Well, what does this tell you? Almost half of that $11,483 is your estimated prepaid or recurring costs, that most of that section you're going to incur even if you're doing a cash purchase. So in my way of thinking, when you're getting a mortgage, I would suggest to you that the way to think about closing costs is the real true closing costs associated with the purchase of the home and getting a mortgage is that non-recurring closing cost number, that $6,043, because most of the costs in that green section, the recurring or prepaid costs, you're still going to incur even when you're buying the home with cash and not getting a loan. That's an important distinction. So I don't ever want people to think that you get a mortgage from us or any lender, that in this kind of scenario, these kind of parameters, that you're really paying $11,400 just because you're getting a loan. That's simply not true. Half the non-recurring costs are escrow and title fees that you would pay anyway, even if you're going cash. And much of the estimated prepaid items, mostly homeowners insurance first year, and your property taxes, the proration amount, not the impound deposit, but just the proration amount, you're still going to pay even if you're going cash. So that's an important distinction to understand as you're getting a mortgage. So in that respect, I'd want you to calm down a little bit when you're looking at that blue line in line F and realize that getting a mortgage doesn't really mean you're going to be paying $11,000 to get that loan. That's simply not true. And I think that's part of the misinformation that gets some folks to suggest, yeah, getting a mortgage is going to involve closing costs of 2 to 5% of your loan amount. That's just way over what the typical average amount really is. And again, as I pointed out, if you're getting a very low loan amount, the non-recurring costs are going to be a higher percentage. Yes, probably will go over 1%, maybe 1.5 or 2. Why? Because many of the closing costs are fixed dollar amount. And so as a consequence, they're going to be the same whether you're getting a $150,000 loan or a $500,000 loan. So you want to make sure you understand that distinction. And then finally, I want to go over junk fees. Junk fees, that term's been around in all the years I've been in the business. And I would say there was a period of time when junk fees were more prevalent. I would say much less so now. So I want to touch on that very briefly, as well as the NAR settlement. First of all, what the heck are junk fees? What are they? Well, they're not third-party fees for services or ongoing expenses for property ownership. Again, I just described the third-party fees for services and non-recurring costs, the ongoing expenses for recurring costs. Junk fees should not be construed as being either one of those. Like I pointed out with this article, they suggested a credit report fee is a junk fee. Nope, not true, nada. That's not the case. Now, in some cases, you're going to encounter junk fees, and I'll touch on what those are in just a second. So if you do get charged any junk fees, they would be considered part of your non-recurring costs. Now, where do junk fees typically come from? I would say generally these days, banks, credit unions, there's really not much in the way of any sort of junk fees. Now, a bank or a credit union or the wholesale lenders we deliver loans to, they all will have some sort of flat fee. They usually either call it an admin fee or they will call it an underwriting fee. I would argue that's not really a junk fee per se. Can you tie that flat fee to a particular activity or service or product? No. I would suggest you just think of it as part of the price of the loan from that particular lender. But otherwise, where we see junk fees more commonly out there is either from a mortgage banker, that's a non-bank type of a lender who sets up warehouse lines so they can fund loans out of warehouse lines. Some mortgage bankers will have some what I call miscellaneous fees. They'll call it by different names: processing fee, doc fee. They'll even call it underwriting fee, like in the case of a mortgage banker, where they have delegated underwriting authority and they are underwriting the file, even though they're not funding it with their money. They may charge a specific fee for that. But is that fee really directly tied to the activity of the underwriter and how much time they spend on the file and what their compensation is? Not really. It's just a flat fee to vaguely describe a service, but otherwise it's really not directly tied to, like I said, an underwriter's time on a file or how much they get compensated. Where you see junk fees anymore these days is from mortgage brokers primarily. We've been one for 27 years. So I will say that mortgage brokers will tend to be charging processing fees or doc fees, again, what we call junk fees. That's where you're going to see them, if you're going to see them at all. And doc fee, does it cost a bunch of money to create docs? No, it's automated. It's in a computer system. You do some input and the computer prints out a set of docs. So in the old days, when I was around long enough where we're using typewriters to create loan doc, different story. Processing fee. Well, you're already paying the lender, or the broker, I should say. Well, actually, in most cases, the broker is paid by the wholesale lender we deliver the loans to. So will some brokers charge a processing fee because they have to process your file? Yes, but that fee is really not directly tied to a product or service that they're performing. Now, one distinction I want to let you know is that MortgageWorks, from the day we started, we decided we're not going to charge any fees at all. We've never charged a processing fee, a document fee, an underwriting fee. We never have, never will. We just don't think that's necessary. We're compensated by the lender when we deliver your loan to them, and that's how we're paid. So we don't charge any additional fees, again, commonly called junk fees, on top of what the lender is going to compensate us for. But one other area where some people will think that there are junk fees involved is really, believe it or not, from the escrow company or the settlement company, as I pointed out earlier. With some escrow companies, on their list of fees, you'll see something like email doc fee or doc prep fee or processing fee or loan tie-in fee. Now, some folks will call those junk fees. I'll defend the escrow company a little bit and say, not really. Why would there be an email doc fee? Well, they would argue a lender is going to email the docs to them. Well, when they get them, in most cases, they have to be printed to be signed. So they would argue that, well, that's a service, that's a task we have to perform, and we're going to charge a fee for it. When we print the docs, it could be 100, 150 pages. There's just the printing costs, right? There's paper and toner and so forth. Same with doc prep fee. They got to print the docs and then they got to break them down. They've got to add their own documents to the lender's documents to prepare them for signing. So they'll charge you a fee for that. Processing fee, again, more generic fee for those two steps I just described. They receive the docs by email, then they got to print them and prep them for signing. Loan tie-in fee. What the heck is that? Well, with a lot of escrow companies, they'll have a base escrow fee, but if the transaction involves a loan, not cash, then they'll have an additional fee they'll charge, oftentimes $200, $300, sometimes $400. And why? Well, because of all the documents, because of the documents that they're going to receive by email, and they're going to print them and they're going to prep them. And of course, all those other labels I just described, you would think would cover what that costs, but they'll add a loan tie-in fee because there's a loan that's being tied into the transaction vis-a-vis a cash deal where there's no loan and therefore no loan docs. Now, in some cases, I've seen an escrow company literally charge 2 or 3 or all 4 of these in addition to their base settlement fee. I think that when you see that, that's more along the lines of maybe they're adding some junk fees that are not really justified. But in a majority of cases, I would say that's not true. You'll usually see 1 or 2 of these on this list for escrow, not usually all of them. And then finally, and this goes back to the article from CNN, there was some discussion of the NAR settlement and the impact on buyers' closing costs. The concern is that the buyers may now have to pay their realtor's commission because of this settlement. But ultimately, and even this article predicted or commented on this, it's too soon to predict. And it could very well be, and we're already seeing evidence of this, that with the NAR settlement, where it's no longer going to be the case that it's automatically going to be the situation where the seller is going to pay the buyer's agent commission, it could be possible the buyer's going to have to pay their own realtor commission, but it's starting to look like that in reality, the status quo may continue. It's simply going to be a case now where the buyer's agent commission is going to be more transparent. It's going to be negotiated by the buyer's agent and the buyer upfront separately in a buyer's broker agreement. But we're seeing some indications that in reality, even after they do all that, that in many transactions, if not most, the buyer's agent commission may still end up getting paid from the seller's proceeds. It's just going to become a negotiating point. So I hope this information will give you some clarity, some understanding of the nitty-gritty of closing costs and why in any transaction, whether it's a cash deal or a loan transaction, most closing costs are valid, they're justified, and in most cases, they are tied directly to a product and service. So from that perspective, it's really not something to complain about too much or whine about, and understand that in a lot of cases, even when you're getting a mortgage, many of those costs you're incurring, you would still have to pay anyway, even if you're going cash. So hopefully with that in mind, and with that better understanding of closing costs, you'll take a more favorable view of whoever it is you're getting your mortgage from, and understanding that the fees are charging not just them. Of course, the mortgage originator is actually the messenger. A lot of the fees that they disclose are not being charged by them. You should understand that too. But then also understand that those costs in almost all cases are justified, and there's very little room for you to be nickeled and dimed to death on closing costs because there's so much regulation involved with them. So I hope that helps. Keep that in mind next time you're getting a mortgage. Understand we don't charge any fees at all, and further understand that if you're going to get a mortgage and you're going to give us the opportunity to provide you that mortgage, we're going to give you all this kind of detail right up front, even before you sign the application, because we want to make sure that you like the terms that we're offering to you even before you sign that application and actually get started with the loan process. So again, that's closing costs, what goes in them, what exactly goes in them. I want to thank you for your time for both watching and listening to this show, and then stay tuned next week when we'll be back for another edition of Mortgage Minute. In the meantime, my name is Art Alvarez with MortgageWorks, where we have the answers and they're on the house.